In this video, I will show you how to finance your first multifamily property. If you've been investing in residential real estate and you aspire to own an apartment building of 5 units or more in Canada, I want you to know that the financing is drastically different from how you have been getting residential mortgages on rental properties that are 1 to 4 units. In this video, I will reveal all of the financing strategies available to you to acquire your first multifamily property. In fact, I'm going to share with you strategies that you may not have heard about. I'll be covering both creative and traditional strategies, and most importantly, I would love for you to walk away knowing when to use each of these strategies, how to use them, and what are the pros and cons. So stick around for all of these details. Let's start with the differences between financing a multifamily property versus financing for a residential income property. When we refer to multifamily, we're referring to properties that have 5 or more units. When we refer to residential rental properties, we're referring to properties that have 1 to 4 units. So one of the key differences when it comes to getting financing on these types of properties? Well, the biggest difference is that over here, you are qualifying for the mortgage based on your income and based on your debts and based on some other key factors. For a more detailed dive into residential income property financing, watch my video on this channel where I talk about financing residential properties, and I talk about the 8 terms and twists you need to be aware of if you are over here. When we're financing 5 or more units, really the qualification is based on the building. It's the building that qualifies for the mortgage primarily based on what is called net operating income. The net operating income is the building's income minus its expenses. And that's what the lenders are going to use to see what this building qualifies for. They look at it. It doesn't mean that you're not playing a part in the role. You are, in the sense that the lender wants to see that you've got some net worth, roughly 25% of the loan amount. They want to see that you have either direct experience in owning a building, or you are going to have a property manager who's qualified to work for you or with you to run the building. But the key difference in determining how much loan we're going to get is over here, it's about the building, and over here, it's about you. So how do you determine what the building qualifies for in terms of a loan amount? And how do you determine how much down payment will you need? There is a misconception that on multifamily, it's 25% down, and that is not true. It all depends on what mortgage can the building qualify for. And the way it works is through the concept of the debt coverage ratio. You really need to become comfortable and familiar with this concept called the debt coverage ratio. The DCR is a way to look at how the building is going to qualify for the mortgage. So there is a calculation that I'm going to walk you through, and you need to also know how the lenders think about it, because sometimes what happens is you as an investor would run the numbers in a way that doesn't take into account everything that the lenders would look for. When you go for their financing with the lenders, they may cut the loan amount down because there are things that they take into account that you have not accounted for. So let me explain how this works. We talked about the building qualifying for the mortgage, not you personally. And what the lenders will do is they're going to look at the building's net operating income. If we deconstruct the net operating income, here is what's going to go into it. First of all, the lenders are going to look at all of the rental income the building generates. So anything that is coming from the rental units, and these units need to be legal, plus any income from the laundry, any income from the parking, any provable income would go into this category. Then the lenders are going to account for a vacancy allowance. And on some of the listings, you may see a building that hasn't had any vacancies. And therefore, on the income and expense statement you're receiving from the realtor or through the listing, you're seeing a zero. I invite you to still account for vacancy allowances. The lenders will generally take a 5% of the rents in vacancy allowance. And that gets us to the effective gross rental income. Okay. The vacancy allowance also, there is a component here for bad debt collection. I invite you to take a 5% for this category. If the appraisal report comes in later and says that the vacancy for this building is 3%, it's going to be at the lender's discretion to go with the lower number. But for numbers purposes, and for you to get to how much down payment you're going to need into a deal, work with the 5%. So that gets us to the effective gross rental. Then we have to deduct all the expenses on this building. And what goes into expenses are your property taxes, your annual insurance premium. I want to bring this to your attention. The annual insurance premium. The existing seller may have a premium on the building, but when you buy it, you may end up with a different premium. So always consult your insurance broker as to what your premium is going to be and use that in your numbers, all right? Because some sellers have preferential premiums because they've been with the same provider for a long time, for example. But taxes, insurance premium, any utilities that you're going to pay for as a landlord once you own this building, that includes water, for common area, electricity for common area, or maybe for some of the units you're taking on, the utilities, any rental equipment associated with that would go here. Property management. Even if you're going to manage the building yourself and that expense is going to be zero for you as an investor, I invite you to use a 5% in your calculation because that's how the lenders think. The lenders are going to account for such a reserve. Also, if you're going to hire a property manager when the time comes and you're going to pay them 8% or 10%, then use that number here because the lender is going to ask you, how are you going to manage this property? If you're self-managing, then, we can work with the 5%. But if you're hiring a property manager that is going to charge you something other than the 5%, the lender is going to see the agreement and is going to use the higher percentage. So it's 5% of this effective gross rents. Also here, the lenders take an additional reserves that you may not account for as an investor. So they may take an admin reserve of 1% of the effective gross rents. And if we're dealing with CMHC loans, they also have more things they take into account. For example, they take sometimes salaries into account for a superintendent. They take reserves for the appliances, and their benchmarks, are what they're called, are available publicly in the CMHC material. So we take the rents, we take the vacancy allowances and bad debt collection, and we subtract all of the expenses, and that gets us to our net operating income. Before I go further, I wanted to let you know that I put together a 1-hour training on this topic with a calculator to show you exactly how to run a debt coverage on a live deal. And you'll also get access to the calculator to filter through any listings that you are exploring, and that will help you determine the down payment. You can get access to this, plus the frequently asked questions investors ask about multifamily through a complimentary tool called the Multifamily Toolkit, and you can access it through the link in the description of this video. So once we arrive to the net operating income, we now are a step closer to calculating this debt coverage. So let's say we're buying the building for $1.2 million, and we would like to get a mortgage on this building for 900,000. I'm just using some high level numbers here. And let's say the interest rate on this $900,000 mortgage is going to be at 5.5%, and the amortization is at 25-year end. If you take the requested mortgage amount and run it through a mortgage calculator, you're going to have a mortgage payment. And if we divide the net operating income by the annual mortgage payment, that's what gets us to the debt coverage. So in simple terms, we're trying to figure out, based on this building's performance, what loan amount would it qualify for? Can it support this mortgage payment on an annual basis that is associated with this loan amount? That's what we're doing here. And when it comes to this ratio, depending on whether we are talking about a CMHC loan, we're talking about a conventional loan, this number ranges from 1.1 to 1.3. 1.1 is available under the CMHC MLI Select program, and 1.3 is calculated on X number of units. Again, these guidelines are available on the CMHC website. But for conventional lenders that are not CMHC insured, they generally look for a 1.25 debt coverage on a multifamily property. And if we're asking for $900,000 and the number is not 1.25, let's say, we need to cut down this loan to make this number work. And the difference then between the price you're paying and the loan you're getting is going to be your down payment. Again, I've put together a complimentary 1-hour training on how to calculate the debt coverage, demonstrating it on a real deal, showing you where the pitfalls are, and sharing with you the calculator as well as the frequently asked questions. You can get access to this webinar through the link in the description.
Hey everyone, we're going to be going back to the video shortly. I just wanted to let you know that I know how overwhelming it can be to finance a multifamily property, especially if it's your first one. Understanding your options, knowing what interest rate you're going to get, what loan amount, how to structure the deal, what down payment, all of that. I invite you to reach out to a commercial mortgage advisor at Streetwise to discuss any deal you have at hand or to get a second opinion. You can reach us at info@streetwisemortgages.com. We've also put together a great tool to help you out. It's called the Multifamily Toolkit. You can get access to that tool by clicking on the link in the description. And in that kit, you're going to get a 1-hour recording of how to run the debt coverage on a multifamily property and what to watch for. That will help you avoid the mistakes that investors make when they run the numbers, and it will help you determine the down payment amount you need. There is also a set of the common questions investors ask about multifamily in that kit. And lastly, you will get access to our debt coverage calculator. You can get access to this by clicking the link in the description. Now back to the video.
Here are the 6 financing strategies that are available to you to finance a multifamily property in Canada. I'm going to group them into 2 categories, and I'm going to show you what they are, when to use each, as well as the pros and cons. So the categories are primary financing, and in this category, I am referring to long-term financing, and the second category is secondary, or what I call creative financing, and that is more of a short-term type of financing. So under primary financing, we've got conventional loans, we've got CMHC loans, and we've got alternative loans. And under creative financing, we've got bridge financing, private money, vendor takebacks, and OPM, which is other people's money. From a big picture standpoint, what you want to consider as an investor is that if you're going to use creative financing to acquire a multifamily, your long-term game plan should be to go back to primary financing. Why? Because over here, this type of money is short-term money. This is going to come up for repayment in 6 months or a year, maybe 2 years. It allows you to scoop the asset quickly, but it's not going to sit on your property for the long term. So it's really a stepping stone to a longer term game plan. Over the long term, you want to switch over to primary financing. These are the types of loans that will offer you the longer amortizations. With CMHC, you can get up to a 50-year amortization under the CMHC MLI product. Under conventional, it's a 25, and under alternative, it's also 25. So big picture is you can start here if you want, but eventually you have to have this type of money on your properties for stability and sustainability. So let's talk about each of these categories. What are they about and when to use them? For conventional loans under multifamily, when it comes to conventional financing under the primary financing umbrella, you would be looking at a loan with a maximum amortization of 25 years. And the lenders over here generally look for a debt coverage ratio on the property of 1.25. Conventional loans are offered by the banks. They're also offered by some lenders outside of the banks that have financing for multifamily properties. They're called monoline lenders. So they only offer mortgages. They don't offer saving accounts and things like the banks do. But over here, we're talking about a 25-year and a debt coverage of 1.25. And the maximum loan amount you're going to get on the property is at 75% of the value. Over here with CMHC, you have great options as long as the property qualifies and the deal qualifies. So with CMHC, there are two programs. Their multifamily rental housing program offers you up to 85% loan to value, and they typically look for a debt coverage anywhere from 1.25 to 1.3, depending on how many units we're dealing with and depending on whether you're doing a purchase or a refinance. Also depends on whether you're going to take a 5-year term or a 10-year term with CMHC. Under the regular program, the amortization can go up to 40 years. Under the CMHC MLI Select program, which is a program that has been created to support affordable housing and housing creation in Canada, they can go up to 95% of the value, and the debt coverage is reduced to 1.1. So they're trying to incentivize developers and property owners to create housing. Therefore, the qualification is a little bit more lenient, and the amortization can go up to 50 years. So this is under the regular program, and this is under the MLI Select program. Now, with CMHC, there is typically an insurance premium involved. So depending on the loan to value, and you can find this on their website, CMHC will add a percentage of the loan amount as an insurance premium to the loan. It gets blended into the loan. You don't pay for it up front. It gets added to the loan and, becomes part of your monthly payment. All right. Over here as well, CMHC tends to be more particular about the value. You may have an appraisal report that says that the property is worth $1.5 million. And CMHC may come back and say that, no, based on the data that we have locally in our systems, this property is worth less than the $1.5 million. Why? Because sometimes CMHC takes into account higher vacancy allowances. For example, if there is history on a particular building that it had a higher vacancy, so that impacts the net operating income of the building, and it can impact, obviously, its value. So great options here. I would go here if, you've got a building where you have maximized on the upside that the building can offer, and you're ready to lock into a long-term CMHC loan of a 5 or a 10-year term. These are the only terms offered. Where over here with the conventional lenders, we've got more options when it comes to mortgage terms. They can offer you anywhere from 1 to 5 years, and you've got fixed rate options, you've got variable rate options, where here with CMHC, you've got fixed rates at 5 and 10-year terms. So I wouldn't go to CMHC until the building has been stabilized, meaning you have reached your highest potential for rents from the building. If you're buying a building that you're gonna improve its condition and increase its net operating income, locking into CMHC is going to hinder your ability to access any increase in value. So go there only once you stabilize the building. This is a great option. If the numbers work, if the debt coverage works, this is a great option. Your interest rates here will be definitely higher than your interest rates here. They're generally 1 to 1.5% higher depending on the size of the loan we're applying for. This option here, alternative lending, is an option that can offer you up to a 25-year amortization. They also look for debt coverage, but they're a little bit more lenient. So their debt coverage can range from 1.1 to 1.25, and they can go up to 75%. These guys here are more expensive than conventional lenders. Their interest rates are more expensive. But the benefit of going here is, let's say you have a building that does not qualify for a 1.25 debt coverage ratio with a bank. Because these guys work with a lower debt coverage, you can get a little bit more money here sometimes. The other thing too is that some lenders here use a hybrid method to get you money. So remember we talked about the building qualifying for the mortgage in multifamily financing? These guys have an option whereby they would use a percentage of your personal income to help the building qualify for a bigger loan. So this works nicely if you're buying a building and you're running your debt coverage and that building is fetching rents below where the market is, but it's being sold at a high price and it's not qualifying for the full loan amount that you're aiming for, we can look at an alternative option to help you get that bigger loan. Because at the end of the day, the loan is going to determine your down payment. So these guys have the hybrid method to qualify the building. What they also allow is options like a vendor take-back mortgage or a second mortgage behind their mortgage. So you can essentially increase the loan amount between the first mortgage and a second mortgage to 85%, which reduces your overall down payment in the deal. So these are the three strategies available to you under primary financing. There are pros and cons of each. This works well for a building that's been stabilized. This is, you can go here if you want to acquire a building and you're going to be turning tenants and holding on to it for quite some time before you want to lock into a longer term loan. And these guys here are a little bit more creative. You can stretch the loan amount a little bit more. You can get to increase the loan to value through creative financing behind their loans, and these would be the long term options available to you. Category of financing strategies available to you to finance a multifamily property is secondary or creative financing. In this category, we've got bridge financing, we've got private money, we've got vendor takebacks, and other people's money. So let's talk about each and what each of these strategies are for and what to watch for. Bridge financing is typically interest-only loans. These are loans that are priced at prime, the prime rate in Canada, which you can look online. That is impacted by how the Bank of Canada sets the overnight interest rate. So they're priced at prime plus a premium. And generally speaking, they are at prime plus 2 to 3%. These types of loans are helpful to you as an investor in two scenarios. The first scenario is, let's say you found a property and you know that you want to go to CMHC for financing. Unfortunately, CMHC takes time to get deals financed, and you cannot sometimes keep the offer alive for a long time in time for the CMHC financing to come through. So what a bridge loan does for you is it allows you to close on time at an interest-only payment with a lender that offers these types of loans, and then for the deal to go to CMHC and once it gets picked up by CMHC for approval and the CMHC financing comes through, this bridge loan gets paid out. So this is a stepping stone to a C loan if you want more assurance around closing the deal in time and not having to be at the mercy of waiting, for the CMHC financing to come through, because, that is sometimes unpredictable. What this type of money also can do for you as an investor is if you are repositioning a building. So let's say you're buying the building and your rents are below the market and maybe your expenses are high, and you know that you're going to enhance the rents, maybe renovate some units, improve the condition of the building, cut down on some expenses in the next 6 months, a year, or 24 months, or even 3 years. If you were to take that building in its current state and run the numbers using a DCR calculator, which I talked about in another video, you will see that this building would not qualify for a 75% loan today. Why? Because its net operating income is low. So what a bridge loan allows you to do is it allows you to acquire it and renovate it with the idea of eventually refinancing it at a higher value to pay off the bridge loan. And you then have the choice to stay with the same lender and get a long-term conventional loan, or leave that lender and go to CMHC. Let's work with some numbers to demonstrate my point here. Let's say that, you're buying a building where the price is $1 million and you are going to renovate this building and you need $200,000. I'm using some basic numbers here. If we get a bridge loan, you can get 75% potentially to acquire this building. Sometimes it can go up to 80%, and you can get money to renovate it. And the percentage of money you can get to renovate can range from 75% to 100% of this renovation money. Now, there are more details to be discussed here with respect to how these loans work. But all I want to share with you is that bridge loans come in handy when you're turning a building around, and it's an interest-only loan, and they allow you to take the asset at a higher loan to value, because if you're just to take it and run the numbers as this, the numbers are going to be low for the loan amount the building qualifies for. So they are great for that purpose. Private money is always an option for you as a real estate investor. Private money is more aggressive, it's faster, but it's also a lot more expensive because there are lender fees, there are broker fees, the interest rate is much higher as well. But private money allows you to pick up assets fast, and maybe certain buildings that are not financeable in their current condition with a bridge loan or with a traditional lender. There are lenders on the street that can do multifamily property acquisition at 90% loan to value. So very high loan to value. But I want to alert you about private money in general. You need to know how to use it, because private money is a two-edged sword. As much as the paperwork is lighter, the loan to values could be higher, it is a faster type of money to work with. It's like the super highway. It's prone to accidents. You really need to work with an experienced mortgage broker to help you understand how you're going to exit this private money. So sometimes you buy a building, you acquire it, and you need to do some work to it and improve its condition and net operating income. And your exit could be to do that and pay off the private money through a CMHC loan or a longer term loan. You need to validate that exit before you enter the deal. You don't want to be in a position where you get excited about a purchase, you get excited about the fact that you can purchase it with private money, and then fast forward when the time comes to refinance it, you learn that You can get the entire loan amount that you're anticipating, or the lender does not like the location or does not like the deal. Private money is like a bomb. It's a bomb that is sitting and ticking, and it has to get paid out at some point. So I highly recommend that you validate your exit strategy with us or your mortgage broker before you enter the deal. What we want to do is we want to say, okay, if you're going to buy a building with private money, what's your game plan going to look like? If you're going to improve its condition and its income, what does the future look like? Let's order an as-is appraisal and let's order an as-complete appraisal. Let's look at your future state. What is it going to be worth? What does the income and expense look like for the future? And let's run the debt coverage and see what loan amount will that building qualify for when the time comes. This way, we make sure going into the deal that we're not stretching ourselves too thin. We're not taking private money this much and, be a situation that we cannot pay it off later. So great creative strategy, but you really need to know how to use it. The third option is vendor takebacks. And a vendor takeback is a mortgage essentially that you can negotiate with the seller of the building. And I've seen vendor takeback mortgages in first position. I've seen them in second position. And here's what I can tell you about vendor takebacks. Because you're negotiating them directly with the seller through the purchase and sales agreement, you do have leeway. You can negotiate how much. You can negotiate the interest rate on these loans. You can negotiate the term, the frequency of the payment, and I would suggest that you negotiate the longest term you can. Don't negotiate a 3 month term. Negotiate maybe a 2-year term. If you're also able to negotiate a balloon payment on the end versus a monthly payment, that would also be great. Now, vendor takebacks are possible behind traditional loans. Under primary financing, alternative lenders will let you tag a vendor takeback. Some of the conventional lenders, like the banks, will also allow you to tag a vendor takeback. However, alternative lenders want to make sure, both lenders want to make sure that the property will still get covered. So if you take the first mortgage on the property, and the property is supporting a loan amount of, let's say, $1 million, and the debt coverage is 1.25. You can't just add a vendor second that will bring this debt coverage down. We gotta make sure that between the first and the second mortgage, the debt coverage still holds. The alternative lenders sometimes let you put a vendor take back second behind their mortgage and without having to meet this criteria for both mortgages. But if you need guidance on how much of a back you should negotiate and what terms, talk to your mortgage broker or talk to us. We'll guide you as to how to make the numbers work. All right. You ideally don't want to negotiate a $500,000 vendor take back to learn later in the game that the lender is only going to allow you to secure $300,000 of that. And lastly, other people's money. Other people's money allows you to pull money from others to invest in your deals. So you are the one who finds the buildings, knows how to make money for everyone, and others who don't have the time or the resources can come together and invest with you. There are two structures from a lending standpoint for setting up this. Other people's money allows you to pull money from others to invest with you. If you have become knowledgeable in buying an apartment building, you're willing to put in the work to make that asset work, but other people don't have the time or knowledge but have the money to invest with you, then this is a great strategy to utilize. And in fact, in commercial financing, it is much easier to work with other people's money compared to residential financing, compared to financing a property with 1 to 4 units. Because here, the lenders look at it as a business. So there are two lending structures that are available to you under this particular strategy. The first structure is a GP-LP structure, And the second structure is a corporation with shareholders. Regardless of the structure, the lenders look at it the same way. If you're setting up a GP-LP structure, which is a more expensive structure than a corporate structure, you're typically the general partner, and you may have one or a few more people who are general partners with you. You're typically the front runners in the deal. You are the experienced investors. You are the ones who are guaranteeing the loan. And then your investors are participating in the investment through what's called a limited partnership. They each hold a piece of this limited partnership. They're limited partners. From a lender standpoint, they want to know who's coming to your deal as an investor, and they also want to know where their money is coming from. Because under the anti-money laundering rules, the lenders need to trace where the capital is coming from at the time of a purchase, and they would want 90 days history on that money. Under a corporate structure, you are the director. You may have one or more people with you as directors. And again, you have to demonstrate to the lender that you are the front runners with the experience and the net worth, and your investors are coming to the money, coming to the deal with capital, and they could be shareholders in the corporation. One thing that I'd like to bring your attention to is the personal guarantees on the loans. If you and the directors are strong applicants, then you would guarantee the loan. If the lender needs more security from others who are participating in the deal, they may look after shareholders or limited partners to guarantee the loan. But again, that is part of planning how you're gonna hold the property with your mortgage broker. We can guide you regarding how to set this up so that you're not surprised later down the road that somebody needs to step in to assist with the mortgage from a personal guarantee standpoint. One of the things you can do upfront to reduce these chances is when you set up your shareholder agreement under a corporation is to keep the shares below 25% and to keep them as non-voting shares. This way, you as a director is the candidate for the personal guarantees. If you have investors in your deal who own majority shares, the lenders would want to see them participate in the personal guarantees. But OPM is a great strategy to utilize to bring money to your deal. It's done all the time in multifamily financing. Whether you choose a GP-LP or a corporation with a shareholder agreement, that is something for you to discuss with your accountant. It doesn't impact financing. But from a lending standpoint, we want to make sure that the front runners, whether they're the directors or the GPs here, can show the lender enough net worth, which is generally 25% of the loan amount. They show that they've got the experience, and the money can come from other people. And there is actually often a minimum credit score required for the front runners as well. It needs to be 650. The lender sometimes may make an exception to take it down to 600. But planning is a big piece of this.